All right. So good afternoon and you're welcome. I want to use this video to tackle um external reconstruction. So far, I think you have a fair idea of how internal reconstruction works, and I want to use this video to discuss external reconstruction. All right. Just so that the exam doesn't take you by surprise. Internal reconstruction and everything, then boom, there comes an external reconstruction, which is not that different from the internal reconstruction. But what you have to understand here is that when we are looking at internal reconstruction, we are looking at existing stakeholders trying to make some sacrifices, all right, to boost up the retained earnings back to positive. So that's the main idea. Okay, so people who are internal, that's the word internal, who already stakeholders, all right, that is trying to help boost up the retained earnings back to positive. But when we talk about external reconstruction, it means that an external stakeholder, stakeholder, meaning that a new company, all right, will have to be born. So somebody is coming to buy you. So that's the main idea. So if the internal reconstruction couldn't hold, then it means that the external stakeholders have decided to come and buy. So what they do is that they are coming to buy. What are they coming to buy? They are coming to buy the troubling entity that the internal stakeholder could not meet, all right, could not help bring back. So they are coming to buy the struggling entity. All right. So what you see here is that the struggling entity is going to collapse because somebody is buying you. Did you get it? Somebody is coming to buy you. All right. So when he buys you, you will no longer be in the picture. So basically, as the new company is buying, the struggling company is disposing. Take a look at that. The new company, whoever the shareholders are, they are coming to buy. And anytime somebody buys a company, do you remember what happens? Anytime at this level, corporate reporting, anytime somebody is buying somebody, what comes to mind? I think you are getting the picture. There must be computation of goodwill because you are buying an entity. Remember. So if we are going to do goodwill, then it means that obviously we will need purchase consideration, how much the people are buying the thing for, and what else do we need? We need the fair value of the net assets at acquisition. Is that not it? So the asset that they are coming to buy, what is the value? All right. So how much are they going to get? So here is just that our focus will be the assets. All right. The asset. Okay, so if they are buying everything, hallelujah. But you see that they would instead of buying everything outright, you see that they will be taking over some of the things on themselves. All right, so like the debtors, they will be taking over to go and collect the money and all those things. So basically, that is it. So as you can see, the concept of the buy brings into mind the issue of goodwill. So we will need our purchase consideration and we will need the assets. All right. Apart from that, everything that you have learned in internal reconstruction, where you will be opening the reconstruction account here, the reconstruction account will be substituted by what we call the realization account. That is it. It will be substituted by what we call the realization account. So I'm going to give you some guiding steps to help you whenever you are preparing an external reconstruction account. All right, I'm going to give you some guidance there. But before then, let me introduce you to some of the journals. All right, and I will use the account to explain them. Okay, so remember, somebody is going to buy, he is paying. All right, once he's paying, so what will happen is that once the person is paying, he is paying, the money is paying into the new business, is his new capital. All right. It's like investing money into a business. You are paying money into a business. All right. So that is your capital. All right. So that is that. So once the person pays, what do we what if you remember what we used to do in consolidation, what we used to do is that we will debit the purchase consideration, and what we will credit, if it is liability is used to pay, we will credit it. If it is share for share exchange, it gives rise to capital, we will credit it. If it is cash, we will credit investment and all those things. So that is that. So what I'm going to do is to give you some guiding principle to actually go about it and be able to prepare the reconstruction. All right. So the first step of activities that you would do when you are faced with a reconstruction question, the first step that you do, step one, is to determine goodwill. All right. Step one is to determine goodwill. Why are we determining goodwill? Because somebody is buying somebody. So there is an acquisition. All right. So step one is to determine goodwill. And how do we determine goodwill? We will determine goodwill by doing the purchase consideration. So you have your purchase consideration, and it can come in so many forms. So you know all the forms that it can come per your console, your steady from console. So that is that. So whatever it is, so if it is, so let me do it like this. It can be that they are issuing capital. So it can be stated capital. It can be preference capital. It can be loan capital. So debenture, all right, that they are using. Okay, so once you total it, you will get the amount. Now, as it is here, the double entry here is the purchase consideration. All right, so as you have it here. So is the purchase consideration, all these purchase considerations that you have, all right, will be credited to the realization account. All right, and the debit is the corresponding account. So stated capital, all right, to so debit the respective account in purchase consideration. All right. So basically that is that. All right. So that is what you go through and do. Don't forget you will less fair value of assets. All right. At the acquisition. All right. Then you get your goodwill at acquisition. If it hasn't impaired, it will be the same as the figure that will go to your balance sheet. So that is goodwill carried down. All right, so that is what you have here. All right, so you have to, and please remember, per your knowledge, goodwill can be positive, it can be negative. So where do we place this goodwill? This goodwill will go to your capital surplus. if it is negative. But it will go to assets if it's what? Positive. All right. So take note of that. Okay. So remember when you used to do console in goodwill, if it is negative, it goes to your group retained earnings. The same thing that we are trying to, all right, discuss here. Okay. So that is that. Now, after you have been able to determine your goodwill, that is a good thing. Make sure you prepare these individual accounts. So step 2, you are preparing these individual accounts. Of the purchase consideration, because those things were inside the balance sheet. All right. So just as you, when you prepare them, that one will help you to know any laws to be written on, all right, to determine any losses to the realization, all right, that you can get. Sometimes I don't want to call it a gain. Let's call it an excess also to the realization. Okay, so we will put it in practice so that you understand everything that we are talking about. Why? Because we need to close out these accounts. Because we need to close out these accounts in the old balance sheet. That's what we are trying to do here. All right, when we close it out, if there is any loss that was on it, then we will take it to the realization account. If you remember, when I was teaching you the internal reconstruction, I said that you prepare the 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 distribution. You will liquidate the company and you will distribute the money. But if there is reconstruction, the first account you prepare is the reconstruction account. If you remember, then you prepare capital account, then the preference account. The figures in the equity side of the balance sheet. You prepare those accounts. Now, the same thing that we are going to do. So you prepare those same accounts, and that is what I mean by prepare these accounts. All right. So you prepare the account and you reflect these things. The same thing, nothing changes. Nothing changes. All right. So basically, that is that. So you prepare the capital account. If it is there, you prepare this account, you prepare this account, but you realize that they are losing up something because you had a stated capital before and they are paying you something and you have to reflect it. That's why here we focus on the assets. All right. Other than that, we will look at the state of the asset at acquisition, the equity balance, and all those things at the time, all right, of the acquisition. You can as well do that. It won't make it wrong. So, for example, you less fair value of net asset at acquisition. All right. So, if you call it net asset, then you look at the equity side. You pick up the stated capital, all right, at the time that they were acquiring it. You pick up the retained earnings, you pick up everything that is there and any fair value adjustment that happened. Then you will determine all sorts of things inside your goodwill, which you can as well do that. So I may even present those kind of analysis in another video, the same question, but solve it in another style as per what you know, all right? Because when somebody is acquiring something, you know that you will need to bring out all its equity side because that's what you are buying, all right? So you bring in the stated capital at the date of acquisition, you bring in the retained earnings that is negative, everything that is there. So therefore, what you will do. So when I'm solving the question, I think I'll do it side by side or use a different video to showcase that one to you because that kind of look familiar. Is that not it? Yeah, that is possible. Because, like I said, your equity side, then any fair value adjustment, you bring it because somebody is acquiring somebody. Console, is that not it? That is it. All right. So that is that. So we can use the net asset. We can also use the asset that they are acquiring. Some of them too, they will be taking over. And so fair value of, can call this one net asset at the date of acquisition, whichever one that you can do. I mean, that's it. You have to understand what you are doing. That's the most important thing. So now, once you have been able to go ahead to do this, the next thing for you to do is to now open a cash account, realization account, all right, and all those accounts that are necessary. What accounts that are? So step 3 is to open the accounts. The necessary accounts. So the most important is the realization, just as you do in reconstruction. So you need to prepare a realization account, meaning you are going to sell stuff. All right. So remember, it is the same thing for your what do we call it? The reconstruction account. So the reconstruction, what did we used to do with it? So remember, you bring the balance brought down of your surplus. So the capital surplus, all right, the capital surplus. That is the balance of your reconstruction if there is it in the question. The same thing here, it will come to realization. So nothing changes. All right. Then here we bring, so you saw the purchase consideration thing that I discussed, that the purchase consideration must be credited to realization. So purchase consideration. All right. What do you remember? Liability, asset. If you remember in the reconstruction account, you have the asset at this side. All right. So when they are decreased, so this one you are buying everything outright. So it means asset. You do here, NC asset taking over. Assets taken over by a new company. So if they take over the asset, it means you have to write off the asset into the realization account. So if your asset had this value, 10,000, the asset is the debit balance, it has 10,000. You write it off to realization, 10,000, then you bring it here. So list all the assets that are taken over by the business. Please remember assets that are what? Taking over, taking over. All right. By the new owner. All right. So, or by the new business. All right. Asset taken over by new, I think, let me call asset taken over by, we call them predators. So let me, or parents. Okay. So that is that. So you can list all the assets. Please remember to list them. All right. List them. If they are more than one, just list them. All right. Then the same, in the same vein, liabilities taking over will also appear here. All right. If they take over some liabilities, it will also be here. Then what are some of the things you remember? All right. The things you remember, like issues of bad debt. You remember them, right? Liquidation expense. And don't forget the corresponding entry of liquidation expense, right? Where cash, right? So remember to open your cash book as well. All right, let me clear this. But let's not use cash. Let's call it bank because let's be more modern. We don't encourage the use of cash. Normally, cash has a debit balance, right? But if it is an overdraft, you know that it will be here. All right. So, yeah. So the liquidation expense you pay here. Okay. So you pay it out. All right. So that is that. Sometimes the business that is taking over will not take over all your assets. There are some of them that they will be handling it themselves. So something like the payables, they will be paying the payables themselves. And so sometimes they will be getting some credit on discount on for paying very early. So if there is a discount, all right, you also have bad debt here. All right, so kind of. All right. Then the remaining amount, so any amount received from the receivables, amount received, all right, receivables. If they receive money from the receivables, it will be here. If they pay money to the payables, which they didn't take over, all right, but they are paying them, so the payables, so let's say creditors or payables, better still payables. I think we are in the modern era, so the word payables makes meaning. All right, so that is that. Okay, so you keep note of this. Like sometimes, like I said, when they are collecting these things, it's like they are factors. So service charges, apart from liquidation, any service charges, all right, is also debited here. And the service charges are paid. So service charges, the same thing as the reconstruction. So if there is any other payment, like let's say dividend payment, it comes here and here because you are paying dividend. You pay. So that is that. All right. So these are some of the things that you can encounter in this reconstruction account. All right. So list all the assets. If you have any bad debt, all right. So take note of that. So you close the account that I made mention here. All right. So when you close it, if there is any loss, all right, when you close these ones, you open an account for them. When you close it and there are outstanding losses, bring it to the realization. All right. So take note of that. So the if it is an from excess arising from purchase consideration, it will be here. But if it is a loss that comes out of the opening account, it will be here. All right. So should I call it loss from the purchase consideration? Yeah, kind of. So when I do it, you will see it. I mean, you can have a right terminology for that because it can come from any of this. You put the appropriate name there. So if it is coming from the stated capital, you write stated capital. If it is coming from preference share, you write preference share. So that name here, if this excess is coming from stated capital, right? If it is coming from debenture, right? All right. So basically, that is that. Those are the things that you will see. Then you will close this account, this realization account, just as the way you used to do with your reconstruction account. All right. So here, if you have this one, it's like it's going to a capital reserve for you. All right. So that is that. Why that? Why that? Because if your balance of capital surplus is here, closing balance, have you seen that balance brought down? Have you seen it? So that is the same thing you do in reconstruction. That's a difference. But here, if it is a loss in reconstruction, what do we do? We share the loss, right? So here it's called loss on realization. All right. So that kind of thing is called loss on realization. So that is it. All these are balances. All right. So you balance this account, balance this account. So you take note of that. So we balance these two accounts just as you do in the reconstruction. All right. And your cash balance too, you will balance the cash balance. all right, as well. Now, look at the catch here. Look at the catch. The catch here is that your cash balance, all right, must be able to balance off with that of the realization. If it does, hallelujah. Because this figure, where you are taking it to, sometimes we say take it to a sundry members account because we don't have really a proper name for it. So we say that you can take this one to sundry members account. The loss, sundry members. Then the cash balance will go to sundry members. So if it should balance, that part should balance. All right. So that's how you know that you are on a good track. So for example, if your balance carry down is here, that's the missing figure. So you're able to balance off this account. So it comes here, balance brought down. This figure should also go to sundry members because we are closing the cash book. This particular cash book, it won't come in our new cash book. It was here, so it will be closed. So this figure should also be here. So this one should be equal to this one. So now if you open this sundry members account, you can actually start it with the original stated capital that was there and put all the surpluses. I don't want to do that. I want to make your life very simple. So you will see that this loss that is here, where do you see it? So loss on realization is here. Then the cash, all right, the cash too will come. So this account balances of itself. Let me use easy so that you know that it balances of itself. All right, so nothing else. That's the end. It balances of itself. It balances of itself. All right, so that is that. So that should be your test. All right, that should be your test of knowing that what you are doing is on the right track or not. That is that. If there is issue of new capital, all right, then it means it is going into the new balance sheet. Take note of that. The new balance sheet of the new company. This thing is to close the old company. So the new balances of the new company. So usually you will start with, if you are doing the account for, so how many accounts is here? These are the major accounts that you see. The major account, nothing much. Your cash, your realization account, that is the most important thing. Okay, that's the most important thing. So that is that. So the new company that you open, if there is new introduction of shares, so you have a new stated capital for that because you have to close those ones that, like I said, some people will keep the old ones over here and finish it up and continue, but there is no point in that. All right, so basically this is you prepare your new balance sheet, on the opening day of the new company. Let me call it new SOFP. All right, statement of financial position. So you have the NCA aspect, you have your assets, and if there is any goodwill to you bring, all right. Okay, so here you prepare the assets, so the revalued amount, the new figures, all right. So you add all your assets together and new introduction of cash, not this particular cash, but new introduction of cash, all right. So you can actually extend this one and start the new account in here. If there is any new cash you bring here, any new stated capital you do, all right. So that one is purely for the new company. So list it down, all right. So you will have it. Okay, then you have your equity, the equity side of it here. The equity side, all the purchase consideration elements, all right. So purchase consideration elements, is here. So list them. If it is stated capital, preference share, and all those things, you can list them. All right. Whatever means they used to buy it. All right. So you can list them. Okay. But if the stated capital, there was plus additional issue. So the issue that comes here for you to have cash. If they issued new shares, additional issue, don't forget to add it. So let me draw the lines like this. Because if you issue shares, it will be added to your stated capital and cash too will come in. All right. Okay, so that is that. But if the goodwill is negative, it must affect your reserve. All right. So whatever reserve. So let me just write here negative goodwill. All right. It must affect it. So if you had some reserve down, you made an additional loss. So negative goodwill must affect the thing. Because if you remember in console, negative goodwill is subtracted from your retained earnings. Remember. All right. So it's kind of an additional loss for you. I think when you add everything up, you won't have any new NCL and all those things. No. So you should be able to balance this. All right. So now let's take a look at a question. Let's take a look at a question. I have a question here. I just typed the question for you. All right. Okay. Let me shift more. That this thing can be open up a little. All right. We can have it like this. Okay, so let's start the approach. He said that MBC commenced business in 2001. Structural changes like changes in management, general reorganization, and dropping of unprofitable product lines could not improve the fortunes of the company. So consequently, in 2016, all the stakeholders agreed that a new company, all right, NBC, was to acquire the GBC. All right, so basically that is that. So it means that the company that was there that is not making profit is the GBC. Okay, so basically that is that. So they are coming to acquire GBC. So these are the finances that are there. So I said step one is to calculate the goodwill, right? So find goodwill. So let's do our goodwill. So goodwill. So like I told you, there are two ways you can go about this. I don't know if to use this video to do the first level because so this is the financial statement that they have. All right. And these are reporting date figures. Reporting date figures. So you said the tangible current asset is this, the non-current asset, sorry. And this is the tangible current assets. All right, we have three. Okay. We have the equity side. These are reporting figures. So if the question gives you the equity side, all right, at acquisition, you know what to do, like the way you do in consult. That's what I was trying to communicate to you. All right, so that is that. We have 20 million, 10% preference shares, 10 million ordinary shares, capital surplus is there. We have the non-current liability. So we have additional information. It says MBC would take over the tangible current asset and the inventory of, so asset taking over. Remember that one. We will debit this one to our realization. Already there is a capital surplus here. These ones will go to realization. These ones will also go to realization. Remember the way we used to do capital surplus, that reconstruction, that one is no news. We will close out these ones to it. Then we will prepare an account for these two. I hope you remember how we used to do it. Oh, no, I've touched it. I hope you remember how we used to do it. So what you open the reconstruction account, you open an account for this one and this one. You put these ones into your reconstruction and account. So that is the same thing. Just that here we won't do reconstruction. We are putting it into what? Realization account. In fact, you can actually keep a realization account and a reconstruction account at the same time. But this is exam. We have to do things to finish early. All right. So that is that. Now, after that, he said MBC will collect the debt. So it means and settle the liabilities of, I think this is GBC. GBC. All right. Paying the paying over the net balance in cash to GBC. All right. So that is that. But there are service charges that are here. So you can do the net and take it to the cash. You pay the net from the cash. All right. But you can just put everything also in the cash book and be fine. All right. So purchase consideration is this. So we now have our purchase consideration. The issue to the preference shares of GBC. Remember, the preference share already have some figures here. This is it. So the issue to them 5 ordinary shares in exchange. You see, I told you every money that they are bringing in is a capital at the same time. Remember, for the new business. Remember that, please. All right. So, first of all, the purchase consideration. Let's look at it. So they said for preference share, what are they doing? So let's bring our CDs. Maybe we need to put this in millions. So the preference shares, they said that they will issue to the preference shareholders of GBC 5 ordinary shares in MBC credited fully to every 4 held. All right. So how much is there already? The number of shares. We have 20 million shares. This is it. So 20 million shares. For every 4 held, they are going to give 5 ordinary shares. And the price is 1,006. All right. So how much are we going to get? 20 over 4 multiplied by 5 multiplied by 1,006. That gives me 40,000. Don't forget the million is reflected here. Okay, next is what? The issue to ordinary shares. So ordinary shares. Ordinary shares. Shareholders of GBC. 1 ordinary share in GBC as fully paid at 1,006 for every 2 held. What is the number of share there? 100 million. So for every 2 held, you are getting 1, which is priced at 1,006. So that will be 100 divided by 2 by multiplied by 1,006. That is 80,000 here. Is that all? The issue of debenture holders of GBC. So we have debenture holders. Debenture holders. Okay. So the debenture, what is the debenture? 12% debenture. So these 12% debenture. All right. So what is theirs going to be? So they issue to the debenture with the 70 ordinary shares of MBC credited as 1,006 for every 1,000 held in. So how much is the debenture? The debenture is 100,000 divided by for every 1,000 multiplied by 70 shares. All right. So basically that is that. multiply by, so for every 1,000 of debenture held. Okay, so how much is it going to be? How much is that one going to be? So they said that 70 ordinary shares, and the price is what? Also 1,006. So that one gives me 112,000. 112,000. All right. So basically that is that. Okay. So there we go. There we go. All right. So these are the figures that we have now. So it means our total purchase consideration is 112 plus 80 plus 40. That gives me 232,000. That is the purchase consideration. But don't forget, I told you that this total will go where? Realization. Good, you remember. These ones are going to their individual account as you see them, but they are at the same time the purchase consideration, the new capital. Don't forget that, because that is what they are buying it, they are bringing in as in their capital. So you see issue of capital at this price, at this price. All right, so that is that. So we've done this. What is the net fair value of net asset? We don't have, we may not have those ones that are given, but usually you know that stated capital, if they didn't issue shares, is the same thing here and all those things. But I don't want you to bother yourself. Just focus on the other elements. So they told you that for the purposes of determining the so fair value adjustment. So like I was saying, you know that this one doesn't change. You know that. And these are reporting figures. So question really didn't give you at acquisition figures. All right. So that's why I don't want you to bother yourself. And you always have it like that. You will not have the at acquisition figures. If you have, fine. I said that for the purposes of determining the purchase price settled by MBC, properties included in the non-current assets here were 30 million more. So 30 million more. That's like a fair value adjustment. Okay, so remember the way you used to do your fair value adjustment. They are 30 million more. So what I want you to understand here is that when you are doing this part, just focus on the asset, this one. All right, just focus on these assets. Okay, so they told you that, for example, the PPE, that is the non-current asset, because that's one that you are writing off. So you have NCA. Focus on that part only, please. NCA is how much? You have 148,000. But they said something that for the purposes of doing determining the purchase price settled by MBC, the GBC non-current assets was valued at, so you have fair value adjustment. We need to add 30 million, right? You need to add 30 million. At the same time, say that the remaining non-current assets were impaired. So fair value adjustment, another one, that is an impairment, which is 20,000. Then again, they said that the inventories, all right, it said that these values were reflected in the opening entries of, yeah, but not adjusting entry, but no adjusting entries were made in the books of GBCs. That's why we are actually doing these adjustments anyway. All right, but these values were reflected in the opening entries of the NBC. All right, so take note of that. So here we have inventory. So the inventory, to how much do you see there? It says that the inventory were valued at 80. So the old plus whatever deduction or addition is still 80. So when we do this, what are we having? It's like 158 plus 80, right? So you have 238,000. So that is that. Just like the way you do console, but please focus on the asset and the amendments that they are giving you. So what do we have? Minus 232. We have 6,000 negative, right? So that's like a negative goodwill. All right, so that is what you have. After you have determined your purchase consideration, what did I say you do? Open the respective account for these things to close them out, all right? To close them out. So respective account, step 2, we have 3 purchase considerations, so we are going to open 3 accounts. So number one was what? Was preferences. Be quick with it. It has a balance already in the balance sheet of 40,000, and purchase consideration also came in, and that one too, how much did we have over at the top here? 40,000. So it cancels out. There's no balance. So we won't see this thing in our new balance sheet anymore. That's what we meant. Open at the second one, which was for ordinary. So the ordinary is the one that you can put in sundry members if you want, but please, it has a balance brought down of how much? 100,000. When they were buying this one, they gave them what? 80,000. So it means they've lost. So purchase consideration, which is the new business capital, don't forget, 80,000. It means they've lost. And when you lose, it is going to realization of 20. Take note of that. So you close it out. Then open the last one, which was the debenture. So that is what I mean by open. So 12% debenture. What's the balance before? Balance. Please, you know everything is in million. We are working here fast. So in your exams, do that. The debenture is 100,000. Per the purchase consideration, how much was given out? How much? 112, meaning that. So 112. So meaning that realization is here for 12,000. So close it. All right. You don't need to write the totals in the exams. So don't waste your time writing these things. Once you've gotten your realization, that ends it. All right. So that is your step 2. So you've done this. Step 3, we said that open the respective account. The main one is realization account and your cash book. Remember, right? So let's open our realization account. Just like our reconstruction account. Then we should also have a cash account, right? As I said, even that one, let's call it bank. Bank. Okay. So the realization account, like our reconstruction account, should start with the balance brought down, if any, which is our capital surplus. Herein, capital surplus is what? 70,000. You realize that we've closed these ones already? We've closed these ones already. So you realize that we've closed these ones already. Even with this one too, we've dealt with it already. Do you realize that? Yeah. The asset too, we've dealt with it already. All right. Okay. So take note of that. So somebody will ask, for the purpose of the reconstruction, the external reconstruction and the purchase consideration, you saw the information down there. So we didn't touch these figures. All right. We didn't touch. As a matter of fact, as we read, you realize that it says that completing the transaction, bad debt arose. So we will do that. Discount received in the early payments for some of the monies to is 10, 10. I don't know how to pronounce this, but since millions are kept at the top, let's stick to 10,000. Debenture has also been paid. Debenture holders had been paid to 31st 2005. Then the preference dividend for 2000, which has not been provided for, was paid in the winding up. So far as something is paid, realization, cash book. All right. So that is that. All right. So, and you had this, and it told you that NBC placed additional 20 million ordinary shares at this price. So this is additional, which was fully subscribed. So that's why we are doing this reconstruction. So basically that is that. So now, write off this one too. You've dealt with this. So write off the income surplus. Write it off the same way you do internal. So that is what? 30,000. This is a debit. You credit it. Well, this is a debit. So you credit it and you come and debit your realization or reconstruction. So this one too. So you realize that this part has been phased out. All right. So take note of that. You realize also that they told you that there are some service charges that you can see. But we said asset taken over. Were there any assets that were taken over? Were there any assets that were taken over? Assets taken over. So clearly, these are the ones that you will be seeing. But the question, they told you that NBC took over only the tangible non-current assets. So tangible non-current assets was taken over. So tangible asset taken over, NCA 148 is taken over. Not only that, the inventory too was also taken over. Inventory is 91,000. All right. So you see clearly you've dealt with this. It means they didn't take over those other ones. But paying over, NBC would collect the debt. So they will take that money back. The new company will be taking those money. And so it says that there will be service charges. You must charge those ones. He said paying over the net balance to GB. So they will take service charges and collect the money and pay it to GBC. So GBC will receive that one in his cash book, all right, so that we can close that cash book out. What is that? 1% of sum collected, all right, and 0.5. So these are the money they need to pay, and these are the monies they need to also collect. But I saw bad debt. Yeah, so bad debt. So the service charge will mean that for the receivables, how much can they therefore collect? It will be, they said, what is the percentage? 1% of, so it will be 1% multiplied by into bracket. What is the receivable figure? 220,000 minus the bad debt. Bad debt is 9. So what will be our service charge? And so the remaining is what they will collect, and that should suffice in our cash book, right? All right. So 220,000 minus 9,000 multiplied by 0.01. That gives me 2110. That's the service charge. So it means that 211 minus 220, 1, 2, 3. It means they are only able to collect an amount like 217,890. So that's how much they can collect. What's my cash book? Balance. No, is there an overdraft? Was there an overdraft? So balance got down 21,000. Now, from the receivables, they have been able to collect the 220 minus the bad debt. What they will get is 217,890. That is what I have. Then the creditors, how much are they paying? How much are they paying? So that one to 0.5. What did they say about the creditors? They also had a discount. So the creditors is how much? 200,000. And they had a discount of 10. So it means they can only pay, you are paying only 190. But you can do this working somewhere and bring the net here into cash receipt as the question stated. All right. So it means that service charge will be what? You know that the service charge for the payables, you are going to do 0.5% multiplied by 190,000. So 0.05% multiplied by 190,000. That is 950. 950. All right. So the service charge too is cleared. All right. And that is it. What else is left for us to do? Per what they told us, dividend to one or liquidation expenses there clearly. 2,000 and you are paying liquidation expense. 2,000. And they say some dividend that was not provided for, preference share dividend that has not been provided. So how much is that? So the figure wasn't given. We have to find it. So go there and this is it. 10% here. So 10% of this should be 4,000. So you're paying the dividend unprovided for. Dividend 10,000. So it's 10% multiplied by 40,000. That's this one was 2,000. This is 4,000. All right. So here dividend 4,000. Did we, when we prepared the respective accounts, you remember this one? I told you what to do with it. So here, ordinary shares difference of 20,000. So realization, ordinary shares 20,000. Then again, this one, it is credit here. So that will be the debenture. That is, the difference is 12,000, right? Okay. So you can now start closing things out. All right. So I think most of the things are now being affected. So you can now start closing the things out one by one. All right. So the cash is done. Everything is clearly put in place. So you can now put everything there. All right. Receivables. Yeah. So what do we have here? We've captured it. 200. 9,000 was bad debt. Oh, hold on. No. 200, 220 minus 9. That's 211. Sorry. 211. The rest that after the bad debt. So 211. All right, 211,000. Okay, so let's close the account. Like I said, the balance you have here, the balance which you can open a Soundry members account is very simple. Nothing else. This is a new issue, the issue new, so which was fully subscribed and paid in cash. It is not coming into this our cash because this our cash balance is coming from GBC balances. So we won't bother these ones. So these ones will be new accounts that you have to prepare. So let's close these accounts and go our way. Let's close these accounts. All right. So let's total. What hasn't come yet? Okay, purchase consideration, the only thing coming to realization, right? And what was it? Oh, we had purchase consideration, you said realization, 232,000. 232. So that's it. Okay. So let's balance everything. All right. So what do we have? Which side will be bigger? So let me do both sides. This is 70 plus 20 plus 232. That is 3. Okay, let me write it somewhere here first. 322,000. And here is 30 plus 4148 plus 91 plus 2.11 plus 0.95 plus 2 plus 4 plus 12. That is 290,060. So it means this side is bigger. So let's put here 322,000. So here gave me 2906, 290060. So what is the difference? Minus 322. All right. The difference is 39, 39, 31,940 is what I'm having. 31,940 is what I'm having. So let me go run over. So this one is 322 here. Is it 322? Yeah, 90 and this. So and let's bring this one. Let me punch it. 30,148. So 148,000. Then plus 91,000 plus 2110 plus 950 plus 2,000 plus no 2,000 plus 4,000 plus 12,000 plus, I think that's it. Okay, so what I'm having here, is it's actually 2990, 299060. So the difference is the reserve. So the reserve that I'm having here is actually 32,940. 32,940. All right. So, ladies and gentlemen, that is that. All right. So 32,940. So the only thing left for us to do is to also close our cash and find out what we can have from it. All right. So let's go back. All right. Oh, I've not written the bad debt, but I have the bad debt. But I punched it here. So it was supposed to be bad debt of 9,000. Right. And the discount. What's the discount? There's also a discount of 10,000, which I have not recorded. So let's record this discount of 10,000. Yeah. So just putting the figures here, punching it without writing. So this one is okay. I think it's 70 plus 20 plus 10 plus 232, right? Oh, so here is actually 332. Yeah, so that is it. To have it here. All right, so you to go through. All right, so this is what we have. 332,000. All right, so that's that. All right, so what else is left? I think everything has been captured, right? All payments have been captured in the cash book apart from service charge. So you can bring the service charge, which was 950 and 211,110. Okay, people are paying for intervention. All right, so I think that is it. This one was for the payables, I guess. This was for the receivables. Okay, so can we close out we check our fate now. Here is 232,000. Obviously, that's the bigger one. So balance carry down should be here. So 190,000 plus 2,000 plus 4,000 plus 950 plus 2110. That's 1990. So minus 232,000. So you have 32. Oh, 32,940. So you realize that when you open that reserve account, can call it sundry members, but I prefer it's like a gain or loss or disposal. So I prefer the reserve account. All right, it's like a reserve that you were doing there. So the cash balance, like I told you, balance brought down. That is 32,940. We'll go to sundry members, which is this account. All right. So sundry members, which is also the reserve. So 32,940. Okay, so here you have from your cash 32,940, and you have from the realization account also 32,940. This account try which tells you that we are on the right track and our work is a success. All right, so basically that is that. All right, so now we are done. Let's prepare our new balance sheet and see where our fate lies. Okay. All right. So you can prepare the new balance sheet. Somebody can also say, let us let these people suffer the realization so that the negative goodwill, so that we can take this one to the balance sheet. Fine, you make a point. As for these things, so the new SOFP to conclude. So we have our asset side. So we have, what do we call it? The NCA. All right. The NCA value is now how much? We have it here. We have our NCA value here from the purchase consideration side. I think this is the part. So that's like 158. That's the value. 158,000. The inventory too was there. Inventory was 80. Then the last statement, this one that they introduce in new cash, can do it in the sundry members account. What you see is that there is a new cash for this new company, which came about because they've issued shares, and that is 20 million shares at the price of 1,006. 20 at 1,006. 32,000. So we don't have any receivables. Everything is gone. All right. So no receivables. Cash completely dealt with. It's only the new cash. So total plus 80 plus one. Oh, that's 80,000 plus 158,000. That's like 270,000. Let's come to the equity, which is the purchase consideration. Don't forget the purchase consideration. So from the purchase consideration, we had stated capital. How much did we get? Because that is the money they used to purchase. That is their new, like started business with cash. So it is 40, 80, 112. So ordinary is 80. 80. But I think there was an additional, the one that they issued. So 80,000 plus 32. This one. That gives me 80 plus 32. 112,000. All right, then the preference 40. Okay. So that is that. But at the same time, they suffer the negative goodwill. So we didn't bring the reserve here, but you can say negative goodwill. Negative goodwill is supposed to affect the reserve, all right, of the new company. We don't have any reserve here, so let's put it negative goodwill. And I think we have a negative of 6,000. All right, so that is that. 122 plus 40 minus 6. That gives me 146,000. Then we have liabilities, right? NCL. So the other part of the purchase consideration, which is 12% debenture, right? So that one too, we have to go and bring it up 12%. All right. So that will be one. Oh, this thing, did I put it in bracket? It is asset that is negative. Sorry. So this is 6,000.